and welcome to Money, Money, Money. The Festival of Lights is here, and we wish all of you viewers out there a very happy and prosperous Diwali. Now, the last 1 year has been quite a ride for investors, from the highs of January to the onset of the LTCG era and the ensuing market correction to the peaks of August. And then once again to the fall of October. The journey has been nothing short of a roller coaster ride, to say the least. However, if you've been systematic in your investment approach, if you've taken care of basics like setting goals and creating a PF plan, then I'm sure you would have weathered this volatility quite easily. And if you haven't, then, well, worry not. It's never too late. And we are always here with help. So let's get started. This is the Diwali special, and we have a special guest lineup for you as well. Joining me on the show today are Radhika Gupta, CEO of Edelweiss Mutual Fund, Ashish Somaiya, CEO of Motilal Oswal Mutual Fund, and Feroze, Azeez, Deputy CEO Wealth Management at Anand Rathi. Thanks to all of you for joining in. Season's greetings, and wish you all a very happy Diwali as well. So where do we begin? As I said, Radhika, I think we will have the lady, kick this off for us. What a year this has been. So when you do a throwback, what comes to mind?
So what comes to mind, so it's been a roller coaster, but in some sense, I think for investors, it's been a good roller coaster. And it sounds strange to say that. I think 2017 was a year where maybe we got very, very complacent about how markets are, how investments are, it's a one-way streak. And I think 2018 showed us some realities. I think what we've seen in 2018, trouble in the credit markets, mid-caps falling, single stock specific issues. This is reality. This is actually reality. And in some sense, it's a good reality check for investors to see, have they set their goals right? Have they done their asset allocation right? Are they investing as per their risk profile? So sometimes a little bit of a healthy correction is also a good sanity check for us.
Okay, so maybe a necessary jolt. Ashish, is it just that? Because the problem is everybody is wondering if this is going to snowball into something bigger.
I think first things first, Diwali is about praying to and celebrating Lakshmi. So it's only in the fitness of things that you conduct the show and she starts speaking first. But yeah, I think
whatever helps investors and the market, let's just say.
Yeah, so I think that, this year has been a reality check, but also keep in mind that everybody seems to be a little bit under the gloom. And it's just the last 9 months or 12 months which has actually resulted in this downdraft. If you see any good product, managed product like a mutual fund or any portfolio that you have, even if you step back and see the last 2 years or 3 years or 5 years or whatever, I think the numbers are pretty much respectable even now. So if you have this odd point of your 9 months, 12 months, 6 months, etc., which is not gone the way you really thought, I don't think there's anything to really worry about. It's just about keeping perspective. I mean, everybody is always told to invest for a 5-year kind of time frame. And, everybody always expects that they should have a double-digit CAGR. But this CAGR concept is misleading because people expect it should be double-digit every year. But if you see the past 20 years, once in every 5 years, there is this downdraft and then things kind of even out.
Okay.
Yes, you're right that, when the going is not great, everybody extrapolates that into the future and then people start thinking that, okay, is it going to get worse? Now, that's difficult to call. But I think the most part of the negative is behind us.
Okay.
That's what I would hazard a guess.
Well, we'll crystal ball gaze in more detail in just a bit. But Feroze, your initial thoughts as well, and what you have seen over the last several months in terms of investor behavior, retail investor behavior. Have people come to you saying, oh, I have more money, should I invest more, the market is falling? Or people coming and saying that, I don't know, if I'm already sitting on gains, should I book out? What's the pulse like?
See, the pulse, I think we're gradually moving towards a more educated investor. That's for sure. And I think whenever you go through a roller coaster, the roller coaster ride is worth it as long as you take away something. If you, again, forget what your learnings are, then it is pointless to actually have gone through this pain. So I think we as advisors are duty-bound to summarize the learnings of what it is. Now, for example, we tell our investors, at least the people we interact with, clearly that looking at the rear view mirror and investing is not a good idea. For example, in 2013, when the Nifty mid-cap's PE was 14, people weren't investing. At 46 mid-cap PE, they were still investing. So you can't just be carried away with the last 1-2 year performance. I think that's one very important learning. Second, I think an important learning is not relying on rating agencies to make debt investment decisions. As long as you can take that away and not forget it, then it's good. So I think people are still interested. I think people don't have a choice but to acclimatize themselves to this volatility.
You have hit the nail on the head, right? That's where the big debate is right now with respect to what the next couple of months, the immediate future really holds. Radhika, I'll actually take off from what Feroze said. Now, this whole issue about rating agencies and whether that can be a benchmark. Specifically, I mean, you also, of course, look at the fixed income side, and Edelweiss has several funds there as well. I mean, for a retail investor who was just warming up to the idea of moving beyond a fixed deposit, this has come as a bit of a jolt. So what should one be doing? Because as Feroze said, that even if you try and be very smart and try and look at what sort of securities this credit fund is investing in, and as an investor, all you understand is AAA. AAA means it should be good. And then there comes an event and a default. So then how do you ring fence yourself? How do you protect yourself? And, what advice would you give?
So I think there are two parts to this. One is a part about the credit markets, and, which I will address. But the second and more important part is what should a retail investor do investing in fixed income. My advice to retail investors has always been that if you're starting with debt, debt is not a place to get cute. You're doing debt for fixed kind of returns, so per se. So if you don't have that risk appetite, if you don't understand debt, if you find it scary, do some of the shorter duration kind of funds. There are lots of categories. There's low duration, there's short term. Do some of that. If you are venturing into credit, then know that credit risk exists. And this is not an isolated event. This will happen every year. I mean, the banking industry has, the best bank in the country has 2-3% NPAs. So it is unlikely that the credit fund industry will not have events like this. If you're not prepared for it, stay away.
Okay. Well, before we take a break and start discussing equities full throttle, Ashish, your thoughts on this? Because what is happening is what, the month of September also taught us, that the equity market is not insulated from what's happening in the credit markets. I mean, there were days we saw stocks fall 50-60% suddenly. So do you think these credit market rumbles, will they still flow into the equity market? Or at least from that standpoint, we've seen the worst?
No, I think we've seen good part of the worst already, but where it impacts is that let us say that NBFCs are playing an important role in fulfilling the whole credit requirement, and if there are issues whereby they are not able to raise liabilities and in fact they have to shed their asset base, what happens is that there will be certain segments of the consumption also, like say there is consumption which is leveraged consumption like real estate, or expensive purchases like large vehicles and cars, etc., which depend on funding from, say, NBFCs. So right now what is happening is that the market has kind of painted everything with the same brush. And, when there is a fall, people are not discerning enough. They just want to sell everything and run away. So it will take a couple of months or maybe a quarter for people to realize that, okay, this is indeed impacted and this is not impacted. Here there is an overreaction and here there is no need to react. So I think things will take a couple of months to settle down. But I think the worst is, we've already seen the worst, and we know which are the impacted parties and how things are playing out. People are now just being circumspect about figuring out if there is any further collateral damage. I think that's the point.
Okay, so Ashish, those are, of course, important thoughts to keep in mind. Feroze, your view on this whole confusing world of, fixed income funds. And in this environment, the advice that was being given at least till September was that 3-year horizon, tax efficiency, go and pick a nice accrual fund, even if it's a credit risk fund, as they're called right now. But now with this IL&FS event, is that advice still valid?
I think it's even more valid. See, rather than picking up ratings, a fund manager needs to be picked on the debt side. Nobody picks a fund manager on the debt side. At least equity fund managers are far more popular. An investor at least knows who the fund manager is. I think on the debt side, a couple of fund managers have done wonderfully well. There's one which is looked at, one thing which people look at is ratings. When I manage treasury for Mr. Rathi, for example, you have something called Z scores. Credit risk funds have better Z scores, which is a good measure of credit risk. So Santosh Kamath, for example, Templeton has done a wonderful job. So point I'm trying to summarize is that don't shy away from debt funds. Choose the best fund managers who have displayed capability of not just going with the herd mentality, but have the courage to pick up credit companies with a lot of analysis.
So in that case, your top 2-3 sort of names that come to mind?
Franklin Templeton Income Opportunities Fund, ICICI Regular Savings and Reliance Regular Savings. All these 3 portfolios, I think, have been designed keeping lot of analysis backdrop.
Okay, well, there you go. Those are some ideas in case you're thinking of fixed income funds. We need to take a break on that note, but on the other side, we turn the focus entirely on the equity market. A lot of people out there are perhaps still holding on to their cash, thinking that maybe better levels, lower levels are coming ahead. Is that the right strategy, or should you start staggering that money in? We discuss this after the break.